Good morning, this is Ken Long from Tortoise Capital with a review of the weekend trading report for August 24th, 2013. We have a market that is in bullish normal conditions on an annual basis with weekly RSI 14. We're at 61 out of 100, so the middle of neutral. On a 10-day basis, we're also in the middle of the 10-day range with a rating of 41 on the 10-day NDX. Looking at the market mosaic here, percent stretch relative to the 200-day moving average is 7.65%, so yellow bullish. The slope of the 50 rolled over even more to red bearish at 0.20%. ADX is still in the middle range of neutral here at 20.9 with bears in charge. ATR percentage at the low end of normal at 0.86%. The risk index is the 30-period moving average of the VIX divided by the 10. When that number is less than 1, we are in a risk-off condition, meaning it's not favorable to be holding, and the risk of volatile moves is high. Looking back at the last 5,000 days, that index score of 0.94 has a z-score of minus 0.83. And you can see the time series of the last 90 days here on the histogram. This has been conditions under which sharp VIX moves to the upside or sharp volatility spikes have occurred. If you look at another measure of volatility here, the standard deviation of the last 30 days of price divided by the price, and then look at that time series over the last 180 days, you can see that we're down around -1 standard deviations. That's the place where volatility has reversed. The last 3 times that it's been there, in each case followed by an increase in volatility, including 2 different spikes. So we are well prepared now for a sharp adverse move and for spikes in volatility that will be great for traders. Looking at the blended monthly rebalancing portfolios, you can see about 2/3 of them are on a cash position when compared to their 4-month moving average. It's the U.S. that's in the lead right now, along with the Euro-Asia blend. So the small caps, tech, mid caps, and the large caps in the U.S. Are in the top position. Looking at the 32 ETF portfolio, it's still dominated by the U.S. with small caps, tech, discretionary, healthcare, and industrials, and financial spiders at the very top. All of the globals are lagging. You can see the difference right now in the sectors, with Latin America and Brazil being down 18 and 12% respectively in the last 3 months, while the U.S. and tech are up around 5 to 6%. So that's a significant variation in performance between sectors that should get your attention. Looking at the market health check, we had this nice bull run here. Pulled back and held at the key support level around 165, and we've had 2 days of improvement, ending in the bottom 2/3 of that channel. So the horizontal line at 171 is the swing high. We've got to see a close above that for this really to be considered a continuation of the bull market that has brought us to these levels. The vertical blue lines are 10, 20, and 30 days of look back, lagged by a day. The thick black line in the middle is the 30-period regression line. The outside black lines are the regression channel formed by the max excursion from the mean during that look back period, which occurred last Wednesday in the low around 164, and it's recovered a couple points since then. The dark blue shaded area is the 30-period Bollinger Band, the river, plus or minus 1. The lighter blue shaded area is the floodplain, 30-period Bollinger Band, plus or minus 2. This is a new add to the health check. We developed this during the last workshop. We wanted a way to get a sense of the fast trend region, in other words, the place where the river or the undercurrent is starting to give earlier indications. Right now that is down. And so we're at a major turning point right here, a decision point for this trend. The river is flat, the volatility is narrow, so it's quiet. So we have a sideways quiet now. We're not quite in a channel yet because we have price outside of the river, but the price trend, this 2-period Bollinger Band, this ribbon, have now rejoined what we're calling the dragon, this dark red shaded area, right at the bottom of the river. This is the natural place for it to continue to resume to 171, the far side of the river and beyond, which, if this bull market move is going to maintain, that's what it should do. And especially after 30 days of sideways movement that is slightly negative. We should now see a move to the upside from the support level that's held for the last 5 days. That's failure to fail further. The next major support level being down here around 157, and a couple intermediate support levels in here. However, 30 days without significant moves up is a bit troublesome, but now it's postured to be able to do that. So now we'll see if it's off to 171 or it's down to 157. And this is a perfect spot for the market to make that decision. It's at the bottom end of the river, right in the middle of the dragon. The dragon's rolling over. The big river is flat. If it fails here, this is not to be, that should not be a surprise. It should roll over here and then violate 165 and then below. But if it holds here, this is a nice support level potentially developing. So we have a strong case for a market that can move in either direction in a significant way with a small amount of price movement to start giving us that indication. That makes this a critical state and perfect for shorter term traders who can frame trades in either direction that have a favorable reward to risk ratio. The last time we saw this kind of roll over, it moved from about 170 down to 164, and that was from this overbought down to this oversold. That's where the percent price oscillator closed and rolled over, and now you can see the jaws here have started to close on the upside, and things are slightly improving with this last hook of the last 3 days. So that's why that makes this a nice support level, but also a failure point at the edge of the river. Both of those are not unsurprising moves, so we have a perfect storm here developing in the market health check. Moving on, 4 out of the 10, excuse me, indexes in the ETF2 model are in cash. That puts us, at 6 on the buy. That leaves us at 60 at 40 invested versus cash in the theoretical model. We're still in bull normal. The S&P at 70 or at 64 is tied with the EFA at 64, but the tie goes to the runner, and so the SPY is slightly favored. Inside the U.S., it's small caps, tech, large caps, and then that should read mid caps. And then the strongest sectors are U.S. small caps and tech. 2 weakest sectors continue to be Latin America and emerging markets. Inside the sector spider for the U.S., we actually had consumer staples and utilities dip into the negative side, but still strong areas in financials, industrials, healthcare, and discretionary. And the leaders continue to be the leaders. For the first time, we've seen the sector spiders start to roll over into cash, and that makes staples and utilities the 2 weakest. World market model, the U.S. is above average with small caps, exceptionally so. 11. We have a selected China ETF here up at the very top. That's PJB. And that is being favored by the China's economic and financial policies to favor their financial sectors. It's a thin slice of the China market. It's not FXI, so that's the area to play in China. The rest of Asia is suffering. All of Europe has been resurgent here, especially Netherlands, Spain, and France. Oil continues to dominate. Private equity is okay, but treasuries and U.S. real estate suffering. Gold and silver have started to make their move off the bottom. So if you were able to get in at silver less than 20, you're a pretty happy camper right now. Inside the business sectors in the comparison, it's basically a balance between the U.S. and the globals. Consumer discretionary in global vaulting into the lead and showing green on the sector. So this is a balancing, a leveling between the global business sectors, where the U.S. has dominated the last 4 to 5 months. It's now getting back towards parity. an exceptional weakness over there in the Australian dollar, so for the currency traders that might be something to start taking a look at. I pay attention really to just signals of red and green when it comes to these currency ETFs. I trade them directly with the futures pairs because these are too thinly traded and there's not enough leverage really to trade them, but they are useful for signals. Little to no change in the ETF top 30. This is the second week, and I want you to notice that silver, the silver miners have been in the exceptional green for relative strength, but have been lagging considerably under consistency, and that is an indication of a short-term significant market shift in silver, which we've seen in the direct ETF, but also in the silver miners, and that might be an interesting short-term tactical opportunity. Solar and financial ETFs continue to be at the top, along with biotech and oil, financials, clean energy. Small caps are still dominating in here. So, and now you're looking at some of the European countries joining the team here with France. Those that are green in strength and white in consistency are ones that are adding new money and new strength to the mix, and so we would be looking at Netherlands, Spain, healthcare, all the small caps, France, more small caps to the mix. Looking at the Dow in the same through the same lens, you'll notice Hewlett-Packard, after a long reign at the top, has got crushed this week, hitting stops along the way. It's now white on strength, but green on consistency. That's evidence of money flowing out, and a sharp shock to the price there from late in this week. New strength leaders: United Health, Boeing, Bank of America. Microsoft moving back up to the top. That's been a brilliant value play for us after the last system shock. We were able to get it around 31, and now it's up around 34 for a nice 10% move. Probably on the news that Steve Ballmer's reign at the top is on short notice. That's only good for their business. The two perennial weak ones over the last 6 months have been Caterpillar and Alcoa, but they are now starting to move up the rack. Coke and IBM are now at the bottom, and IBM is the only one that's red on strength in the entire Dow. So we're seeing a slowdown now in the Dow large caps and a rotation among the leaders, and that's indicative of what's going on with the U.S. large caps altogether. So we can see some leadership changing there. Just some reference charts there on the ETF liquidity. This is average daily dollar volume over the last 30 days. Exceptional volatile in green, exceptionally quiet in red. Shifting to the Monday's trading plan, no signals in overreaction or channeling. Quite a few channeling and overreaction among the large caps. And then all these in the auto framer test out at better than 2 to 1 on a reward to risk basis. You can see that the bearish trend is still strengthening slightly, although it's not formally a trend yet. It has to be above 25 on the black line for that to occur. You can see volatility has bottomed out here and is starting to sneak back up into the low end of normal, and that coincides with our risk index, which shows that a little more dramatically. But that's a precursor of potentially sharp volatility moves. So we'll be careful with that. Dow tactical summary: Hewlett-Packard offering a 10 to 1, 10.5 to 1 reward to risk ratio. It's at a 10 on RSI2, so it's a short-term opportunity, both channeling and overreaction. So that's a very reasonable one. Along with Cisco, offering 5 to 1 and a channeling and overreaction, and 3 on RSI2. So we'll be taking a look at those during the weekend webinar later tonight. Microsoft was the big winner on Friday with a 7% gain, and no other signals, but that could be a momentum play there. It has to get above 36 before it's a breakout to new highs, so there's some good potential in Microsoft for you. Among the ETFs, no patterns to speak of, but quite a few testing out better than 2 to 1. Consumer Staples, XLP, offers 4.4 to 1 and a 3.1 on the Frog standard deviation, so that's of interest. Two remarkable moves. Maybe those are just overreaction plays from Latin America and Brazil, who turned in stellar performances, along with silver at better than 4%. You can see the resurgence in silver here over the last 1 day, 10 days, 1 month, and 3 months. The auto framer speaks for itself there. It gives you all the framing data you might need for symbols that test out better than 2 to 1 on a reward to risk basis, not taking into account any particular patterns. And you can see the initial risk for our short-term swings and intraday trades. Added a new measure of volatility to the mosaic here, so we've got 6 now instead of 4. That's this. I'm comparing the standard deviation of the last 30 days of price divided by the price, so that's a percentage basis, and you can see where we are compared to the last 180 days worth of norms. That can go from 1% to 2.5% during volatility spikes, and that coincided with both of these sharp sell-offs to the downside there. Regression line, 30-period regression line slope, you see is now still negative. It's bottoming out here almost 2 standard deviations below the 6-month average, and that's a couple more days of strength, and then this oscillator will have reversed and then starts creating the conditions for belief in the upside. So that potential is certainly there, and it's a good long distance back to 171, the swing high. So that can be framed as a tactical trade, but then also failure here, it doesn't take much more failure to start erasing all the quality of the past 6 months and have people looking at bear markets on the downside. That's why I call this a critical state, and it's of much interest to us. The rest of the charts are just data points and reference points, which I will just flash through. You'll notice the SPY's Z-scores are all well within the bounds of normal. We are poised for sharp moves in either direction because of the consolidation zone on both sides during the last week. The fact that the market couldn't fail further, to me, lends strength to the potential upside that this will be seen as a buy on dip opportunity after 30 days of consolidation and failure to fail further. Notice how the exceptional moves here in Microsoft, it's already cooking along quite well. That's people hitting the buy signal on Microsoft quite a bit, and I still think there's more available until it gets above 36. You got a couple bucks yet of tactical trading, and you can see the relative weakness in XLP here. That's painful for those Dow large caps and S&P large caps. The 10 period has rolled over the slope of the 10 period regression line. The 30 is down near the bottom of its normal channel, so this is a natural place for it to find support near the bottom of the river. But you can see that the river is now facing sideways, and it's the longer term trend, the 90, is still above the 0 line, but it has weakened since the last, in the last 60 days with this sideways chops and then a couple of sharp days down. We've really only had this one sharp move up here about a month ago. And so there's a decay in the longer term strength signal, and that I think is a reflection of a more balanced approach in big money between the U.S. and Europe, which has been the beneficiary of that profit taking, in my view. And again, more reference charts, which I'll leave up to you. See the resurgence in tech and the relative decline of the Dow on a relative strength basis compared to the S&P. Starting to see strength in IWM continue. So, in my view, it's a favorable upside. The globals are generally all above the 0 line now, and so that's strength flowing into the globals on a relative strength basis, and this is normalized against the S&P. And that's everything I want to cover today, and I'll see you guys in the webinar tonight and then in the chat room tomorrow. So good trading, and take care. Keep your risk measured and your powder dry.